Ed Yardeni was speaking earlier, and he said that I'm always optimistic. But I actually feel very positive that anything 2021 does will be better than anything that happened in 2020. So Ed, why don't you take over, talk about your outlook for 2021, where you see things happening. We're always honored to have your presence here. Thanks so much.
Thank you. And I have until what time you figure? 9?
Let me see. Yeah, you've got till 9:15.
9:15, perfect.
Yep.
Okay, so I'll talk for about 15, 20 minutes, and then you'll be able to field questions to me?
Yeah.
Good. All right, well, look, I'm here in Long Island, and it is a little bit on the chilly side, but I still like four distinct seasons. Before the pandemic hit, I actually gave a talk to a group down in Florida, and this was, I guess, a few months after, well, this was
Ed, you went on mute.
Okay, good. Is that better?
That's better. Yeah, sorry, Ed.
Okay. Yeah, it's got to be a lot better than being on mute. Well, as I was saying, I'm here in Long Island. We've got 4 seasons. It's a little bit on the chilly side, and I am jealous of the Florida weather. But you folks really shouldn't be hyping up Florida as much as you are, because we're all going to come down there, and it's going to get very crowded. And before you know it, all the things that you don't like here, except the weather, are going to come down there. So keep a low profile on just how great it is. Again, before the pandemic, I visited Austin, Texas, and I remember that as being a very kind of sleepy little town, and very easy to get around. And now it's just a mess. Every block is under construction. The traffic's terrible. So it's good to be a place where everybody wants to go. That's the good news. The bad news is everybody wants to go there. So for now, I'm going to stay here in New York. Let me just get right to it. We're still in this world war against the COVID virus. And like most wars, there's more than one front. And in this situation, we have 3 fronts. We have the health front, we have the financial front, we have the economic front. If we don't win the battles on the health front, then the other 2 fronts really don't matter very much. Where are we on these 3 fronts? Well, I think we've made a lot of progress on all 3. On the health front, we're now seeing setbacks. Again, that's the nature of wars. You make progress, and then you have some setbacks, and then we certainly have a setback on the health front with for the United States. There really is not a second wave, but it's a 3rd wave, and it's the worst wave of the pandemic, and certainly in terms of hospitalizations. But then on the other hand, we're at a record high in the stock market, most recently because in November, which turned out to be the month for so far of the Santa Claus rally, we had some really good news on the vaccines. So we had the election was over, and I think there was a big sigh of relief that at least that was behind us, though maybe it's not. But then that was on a Tuesday, and then the following Monday, Pfizer announced that they had a vaccine, and then the following Monday after that, Moderna announced, and then after that, AstraZeneca announced a kind of a more questionable issue about what they really have. But the market started to see the possibility that by the middle of next year, we would find that a lot of people have been inoculated, and the worst of the pandemic is over. And by the second half of next year, things will be back to some semblance of normal. With regards to the financial front, things look just horrible back in February and the first few weeks of March. The credit markets seized up. We had a terrible credit crunch. We had a mad dash for cash. The stock market crashed by 33%, in basically 20 trading days. And that occurred from February 19th to March 23rd. And on March 15th, the Fed came in with QE4, and the market wasn't particularly impressed. To be fair, March 15th was Sunday. They announced QE4. Monday, the market takes a dive, partly because the president announced that if governors tell us to stay home, we should stay home locked up. And that's exactly what happened that week when California and New York and then other governors announced that we should stay home. So we had a lockdown recession. That lockdown recession lasted March and April because we started to ease off on the restrictions. But on March 23rd, the Fed came in with QE forever, open-ended purchases of treasuries and mortgage-backed securities, no particular time limit. The only limit on it was they would do it until the crisis was over. And so they poured liquidity in. And as you know, the analogy that people were using prior to the pandemic was that the Fed was using bazookas to deal with the after effects of the financial crisis of 2008. And then the talk was that if necessary, if we had another problem once again, that they might use helicopter money. Well, they put away the bazookas. They didn't even bother with helicopters. On March 23rd, they went to B-52 bombers, just carpet bombing the economy with cash, a tremendous amount of liquidity. And it's still pouring, and it's now showing up in the money supply. Just the last week of November, M1 increased by almost $500 billion in 1 week. M1 is up 56%. M2 is up like over 20%. Now, we were all taught in college in economics that inflation is a monetary phenomenon. And for the past 10 years, we've unlearned that lesson and became skeptical about that. I guess we're going to test it, with, monetary, easy monetary policy on steroids and on speed. I mean, it's extraordinary the amount of liquidity provided here. So guess what? Credit spreads came down. The stock market, it's low on March 23rd. I'm pleased to say that we wrote a piece on March 25th in the morning. We released a piece saying that we thought we made a low on March 23rd. Don't fight the Fed, don't fight the central banks. And we didn't think we were going to retest that low, but we didn't expect that we'd be making new highs by the spring and the fall, which is what we're doing. But I think the market continues to move higher on all this liquidity. My main concern is actually a melt-up. I'm using 4,000 by the end of next year, but we could be there by the end of next week, the way things are going. And it does kind of feel like maybe we should be playing that Prince song once again, Party Like It's 1999. You might recall there's actually some analogies. The NASDAQ's up like 80%. Back then, the NASDAQ was up 200%, so we're about halfway through that. Back then, Yahoo was the hot stock. This time, it's Tesla. So there are some similarities already, and of course, valuation multiples aren't exactly cheap. But on the financial front, tremendous amount of progress. And if in the near term we have to worry more about a melt-up than a meltdown, that's not a bad situation to be in right now. On the economic front, again, we've had a V-shaped recovery. There's a lot of skepticism about that. There was a lot of talk that we wouldn't get back to where we were until the end of next year or 2022. But now it looks like the recovery is so powerful that we may very well get back to where we had been in 2019 sometime next year, maybe the second half of next year. And the same thing goes for earnings. For the S&P 500, 163 is what we did per share in 2019. And we could be there again very soon next year, maybe again in the second half of next year, going on to new record highs in earnings beyond that. Look, I think we're going to get through this pandemic. I think the market accurately anticipated that the vaccines would be forthcoming. Love them or hate them, Operation Warp Speed probably contributed some to that, but we've also made tremendous progress in the technological areas of biotechnology with mRNA technology, which has delivered the first 2 vaccines, and that's promising in terms of all sorts of biotechnological innovations for other kinds of diseases. So this is fantastic news. And in my mind, my working hypothesis is that once we get past this, we could be looking at the roaring 2020s. You may recall from history that the 1920s were preceded by World War I. Back then, They didn't know about World War II, so it was called the Great War. And then the Great War came to an end after slaughtering millions of soldiers and civilians, and the miserable, horrible wartime conditions in the trenches. The soldiers came back home, they were sick, the population was sick, there was shortages of food, just just a feeding frenzy for a virus like the Spanish flu. And that's what happened in 1918 and 1919. And then we had a few waves there, and that went away. But can you imagine, we all just had Thanksgiving meals with our closest families because we couldn't invite anybody else. And can you imagine what Thanksgiving dinner must have been like in 1920? World War I had ended, killing millions of people. The pandemic killed millions of people. And then we had not a recession. Back then they called them depressions, and it felt like a depression. So my God, it must have been just a horrible feeling with nothing to look forward to. And who could have anticipated, except maybe a few people, the revolution, the technology revolution with automobiles, with manufacturing assembly lines, with penicillin, with electricity, with light bulbs, with appliances, so it turned out to be the roaring 1920s, and we ended that with a crash and then a depression. The 2020s started with a pandemic. We've had a recession that lasted all of 2 months, March and April. I don't think we're going to have another dip here. We could certainly have a slowdown with the lockdowns here, but I think a lot of us have learned to kind of live with these lockdowns and work around them. But again, I think the perception is, and the likelihood is, we'll get through it in the next few months, and beyond that, the economy could be absolutely booming. My wife and I have a credit with Iberia because we were supposed to go to Europe last summer, and obviously that canceled. They wouldn't give us our money back. They gave us a credit. So I told my wife just the other day, you may want to call up Iberia and schedule the flight for the summer. She said, well, the news is still terrible. Don't you want to wait? I said, well, everybody else is going to be scheduling flights for the summer. Look, compared to the Spanish flu, this isn't killing anywhere near as many people as back then, but it's a horrible situation. And as Marty said, we do feel horribly for those who suffered and have lost people. But the reality is we've all gotten cabin fever, and we saw the impact of that on spending, at least on goods, coming out of it in March and April. Retail sales rose to an all-time record high in the summer. Now imagine what will happen next summer when we all relieve our cabin fever by traveling and by going back on business to visit accounts on a face-to-face basis. So a lot of the service areas that have been held back by the pandemic are going to be absolutely booming. And meanwhile, we've got a housing boom that I think will persist because of the pandemic. Quite a few people have decided they don't want to be renters in urban areas and have been buying new and existing homes. And that's had knock-on effects of creating a tremendous housing-related retail sales boom. And the millennials, many of them in their late 20s, early 30s, some of them may have gotten the message that maybe it is time to move out of a city and not be a renter, at least, and buy something. So we're seeing a lot of that. And I think that will, in fact, continue. There is a lot of concern that inflation might make a comeback, but in my roaring 2020 scenario, productivity makes a comeback, and that the pandemic in many ways kicked our butts, technologically speaking. A lot of us have been thinking about and slowly implementing some of the new technologies, whether it be artificial intelligence or robotics or electric vehicles or high capacity, high storage batteries, robotics, automation. All that allows us, by the way, to bring supply chains closer to home. I think because of the Cold War with China, we are going to find more diversification out of China in supply chains. But I do think that the world has been running out of cheap young labor anyways, because demographically that's been the trend. And so I think there's actually a lot of sense in moving supply chains back home. And there's a lot of technology that actually will allow you to do that in a very efficient and cost-effective way. So I think productivity is making a big comeback. We're doing work that's confirming that companies responded to the pandemic by slashing costs. And now they're finding, many of them, that their businesses didn't collapse as much as they anticipated or at all, that their businesses are better and their margins are off the charts. And I think a lot of them are going to do the best they can to keep those margins going. So that's a very good story for earnings. Let me quickly run through a few charts, and then I'll leave some about 10 minutes for some of your questions. So let me share my screen over here, and we'll go there. And I'll hype up my website here. It's not the prettiest website of them all, but it is probably one of the most comprehensive, at least in the field I'm in. It's Yardeni.com, and we have just hundreds of chart books that are automatically updated on our website. We've been kind of virtual for quite some time, by the way. We've been virtual since 2007, so welcome to our world. We don't have a corporate headquarters. Our people work wherever they want to work. We're kind of lean and mean. We haven't even used video technology all these years. We've used just plain old vanilla email to do what we're doing. Our website automatically updates thousands of charts that go into hundreds of publications. But here we're looking at the website, and I'm going to go to stock market fundamentals and metrics, and we're going to look at my Zoom charts. And we're all Zoomers now, of course. So let's take a look. Okay. All I got to do is get this mouse to want to work. There we go. Okay. This is probably going to be a fast run through here of a few charts, but we've already discussed the background to these charts. Real GDP. This is my kind of stylized, smoothed look at what real GDP is doing. It took a dive here. We had a 2-month recession, March and April. It hit the first quarter, -5%, second quarter, -31%, all annual rates. Third quarter came in at 33%. Like everybody else, we thought that we wouldn't recover until the end of 2022 when this all got going. And then we thought the second and third quarters could be down, but along the way, we wind up saying that the second quarter was much worse than we anticipated, and that it was really packed in because of the lockdown. So we started thinking positive for the third quarter. First, we said 15%, then 20, then 25, 30, and it turned out to be 33. In the fourth quarter, we thought could be a pretty good quarter, like 10%. We lowered that to 5. But now I'm thinking the other way, because the Atlanta Fed's real GDP now is tracking at 10%. So it definitely looks like a V-shaped recovery. With the new wave of the pandemic, I think we're going to see things swoosh a little bit, but not double dip into the first quarter. And then by the second half, it could be a boom. So this is kind of smoothed out. But I think a more realistic view is slower up ahead here than a boom. Like everybody else, we're watching all the weekly indicators that are available. We've been watching petroleum products supplied, particularly gasoline. Took a big dive here in March and April, the lockdowns, as hospitalizations increased. Then we all behaved ourselves, stayed away from each other. And I was hoping we'd come out all wearing masks, but the lockdowns worked, hospitalizations came down, we lifted the restrictions, the economy started to improve, as evidenced by gasoline usage. You can see me filling up my gas tank right there in mid-May after 2 months of hunkering down. Then we started partying again in July with July 4th. Hospitalizations went up, but the overall economy continued to boom. And then hospitalizations went down, and then kids went to school. We had our Labor Day parties. We weren't wearing masks, a lot of us, and hospitalizations have gone back up again. But again, I think we're probably going to be topping out here pretty soon. and setting us up for things getting better. So the health front progress is in sight. Setbacks are occurring right now. On the financial front, the Fed came in with the Treasury. I call the Fed and the Treasury now T-Fed. I put the two of them together. Modern monetary theory was embraced in our country on March 23rd with QE forever, Fed buying treasuries, offsetting the CARES Act by the end of that week, dramatically increasing the deficit. And the Fed clearly is committed to providing this kind of liquidity. And modern monetary theory, I think, is a crazy theory, but it's working. And I'm an empiricist. I'm not a preacher. I don't do good or bad. I do bullish or bearish. Right now it's bullish until it isn't. And it won't be bullish when and if inflation comes back. But that's a whole nother story. And Marty may have to give me another opportunity to get into that one.
Ed, I got to interrupt you on the modern monetary theory. It seems to be working in the U.S. What about the rest of the world? Because they all have their own currencies,
yeah,
et cetera.
Well, I think Japan has actually been using modern monetary theory for years. And I think China has been kind of doing the same thing. I mean, modern monetary theory really isn't modern. It's not monetary. It's not a theory. It's really more fiscal theory, if anything. The idea that, as you said, the government should be able to spend as much as it likes, as long as it prints its own money, because it can always make the interest payments and the principal payments by printing more of it. And even the MMT folks say the only hesitation would be if inflation comes back. But even some of the extremists there say, don't worry about that. You just tax the area where there's inflation. It's a crazy theory, but it's working right now. And again, Japan's been using it for a while, and Japan is my model for where we are and where we're going. Not Weimar, not Zimbabwe. I don't think we're going to get an inflationary surge out of this. And that's because of some very powerful deflationary forces that have been operating for at least 40 years. In my career, I've been a disinflationist because of these forces. And one of the big ones is demography. And demographically, we're saying people are getting older and we're not having babies. There's, the nursing homes are getting crowded, and the maternity wards, there's, vacancy notices there. So I think demography is a huge factor here in why we're not getting inflation. And maybe MMT is actually the right mix of monetary and fiscal stimulus for I call it the voluntary self-extinction of the human race. But Marty, we can discuss that another time as well. Leaving you with a lot of teasers here. A couple of bottom lines here. The Fed would desperately like to see inflation overshoot for a little while. If they can get 2.5%, 3%, they'd be delighted to get that. I don't think they're going to get it, but they'd be delighted to get it. And even if they get it, they've pretty much announced that they'd like to run the economy hot. So I think they are targeting the bond yield below 1%. If it wasn't for them, the bond yield today would be at 2% based on things like the copper gold ratio, based on the purchasing managers index. But we're not the only ones doing MMT. We're not the only central banks that are on steroids and speed with ultra easy monetary policy. This is the balance sheet of the major central banks, highly correlated with the PE here, highly correlated with the PE of the FANGs, and so on. So the financial front, great progress. The credit spreads have narrowed dramatically. Junk bond yields, all-time record low. Investment grade corporate bond yields, all-time record lows. And the mad dash for cash and the credit crunch just disappeared with the carpet bombing of the economy with cash. And look at figure 8 here, which shows you that corporate bond issuance all-time record high. So there's a tremendous amount of liquidity in the system. Look at liquid assets, all-time record high. It's now starting to come down. Imagine that, well, you don't have to really imagine. Think that we're going to get a vaccine. We're inoculated by the second half of next year. It's starting to feel like the normal again. There could be $1 trillion to $2 trillion just in liquid assets that come back into either the economy and or price inflation, CPI inflation, and or asset inflation. And I'm inclined to think it could come back into the economy and into asset inflation. Speaking of asset inflation, up and away here in the S&P 500. I'm happy to see that the market's broadened out on the vaccine news. That's a healthy development. People are looking for value and they're finding it in emerging markets and other places, which I don't really have a problem with. But I'm
Hey,
still,
Ed, I got to interrupt you again. So, I guess it's like Soros is a big believer in something called reflexivity, whereas if you print lots of money, something happens on the reverse end. And in 2008, you know, I guess the Fed started printing like crazy in 2009 and 10. And we had Paul Stevens come in, who was one of the founders of this investment bank that specialized in Robertson Stevens,
yeah,
right? Asset manager too.
sure.
And he said, I don't believe the Fed. I'm buying walnut farms, and I'm investing in this little thing with my sons called a Bitcoin mine. And Bitcoin was like $10 at the time. So any thoughts on what reflexive actions will occur as a result of this modern monetary theory? I mean, Bitcoin has taken off again.
Well, I don't have to predict it. I mean, you can see it in this chart, figure 10. I don't have a chart of home prices, but home prices look like they're about to do a sequel to what we had in 2004, 5, 6. Tremendous housing boom. Look, I'm not a Bitcoin or gold kind of guy. I focus fundamentals, and I need earnings, and I need dividends. I need coupons. I'm not telling you that. I mean, I think since we're kind of in a twilight zone environment that we've never seen before, I don't really have a problem with owning some gold or silver. I personally own some silver, not because it makes sense to me, but other than, if it makes sense to others and the world really gets crazier, you probably want to have some of these crazy ass assets. Don't quote me using that word. But with regards to Bitcoin, it's for the chartists. It's not for fundamentalists. I don't have earnings. I don't have dividends. I don't have coupons. If you got somebody who's a really good technician and knows how to analyze a Bitcoin chart for you, I look at that chart and, it's just gone straight up. And when I see something going straight up and kind of retesting its all-time high, maybe making new highs, I want to short it, quite honestly. But what do I know? I can't help you on the cyber.
Any thoughts? I mean, you mentioned real estate. Any other thoughts on any other hard assets, collectibles?
Yeah, I mean, again, I don't do art. I've got some art that I bought down in Miami, down in Key Biscayne before the expensive show, and so my taste in art is, if I like it and it's a few $100 or a couple $1,000, that's good enough for me.
Sure.
I'm not going to be, I'm going to be honest with you. I do stocks, bonds, commodities. Commodities, I don't know if they're an asset. The commodities, are basically used for manufacturing or to eat, and they're highly volatile. And I think we're back in a commodity. I don't know if it's a bull market, but it's certainly a rebound as the global economy improves. So
it's actually an interesting time because some of the tax agenda changed in terms of collectibles, whereas only real estate gets very specific tax advantage, carriage, so to speak. And
yeah.
so even your art pieces, you can't do a 1041 exchange on anymore.
Yeah, Marty, what can I tell you? I'm not a Bitcoin guy. I'm not an art guy.
No, I'm just saying.
I stick to my knitting. I stick to what I know and what I've done for 40 years. So I'm going to stay with that. And that means personally, I've missed Bitcoin as an opportunity to get wealthy. And I think I've got a couple of pieces of art here that might be worth something, but
no worries. Keep on going.
So figure 11, there's, PE times E. We've got the PE has soared here. Look, we're all wondering, and I don't know that I have the answer, but what should the forward PE be when the Fed funds rate is 0 and the Fed is targeting the bond yield to be under 1%? I know that if you take dividends today and divide it by 2%, the dividend yield approximately, guess what? You get the stock market to where it is today. If the market was to start to arbitrage between the dividend yield and the 1% that we're seeing in the bond market today, the S&P 500 would be at 6,000. So thank God the market isn't going totally crazy here and discounting a 1% dividend yield. I think the market's figured out that we're not, the 1% bond yield is being artificially kept down. And again, you can look at the copper gold ratio and a few other things to say that, it doesn't make sense to discount 1%. hopefully the market just goes up along with earnings. Earnings tend to go up 6-7% per year. But again, I'm worrying about a melt-up situation. Earnings are making a comeback. I've been begging the market to go sideways for a little while here, but it just won't listen to me. I'd like to have some time to see earnings pick up, and you can see the weekly earnings estimates by the analysts have turned around, so that's good news. Marty, I don't want to continue on in this monologue or dialogue. Let's take a couple of questions or have I already run out of time? I think I got 4 minutes if I'm not
You
mistaken.
got some time left, but Ed, but I was wondering, I mean, I know that, I'm sorry, there's a question here right now. Okay, this is a different discussion. So you had talked about asset inflation, but I guess some of the programs that are out there right now for credit for people who are paying rent, those are going to be expiring. And do you have any perspective on short-term consequences and longer-term consequences of that if the House doesn't act, if the government doesn't act?
Well, there's a lot of concern that if we don't get a stimulus package of 500 billion to a trillion, I mean, all this money has become funny money. I mean, I guess once you cross a red line, there's no going back. And yeah, I think it could hurt. But we've got a housing boom going on. We've got a lot of service economies have actually bounced back. But between the pandemic leading to another wave of selective lockdowns, and with the potential that something like I heard 10 million people could be evicted from their homes, and so that includes a lot of families. So that would be just horrible. But all in all, I think it just means that the economic growth could be kind of flattish in the first quarter, and that once we get the vaccines, the boom will be back. And it will be a strong second half of next year, and the market looks ahead. So in terms of the financial consequences, I don't really see much of a setback, though. Maybe it'll, having the economy disappoint for a few months will be good in terms of having the market kind of go sideways for a while. But you can't get away from the pain and suffering that a lot of people are going through. And while everybody's debating, whether we should wear masks or shouldn't wear masks, and whether all these small businesses that are suffering too bad. I mean, it's just a crazy environment. But hopefully this craziness will be behind us by the second half of next year, and the market does look ahead.
Yeah, I mean, I don't know where the segment that's like restaurant and hospitality is in terms of your part of the analysis of the economy.
Yeah, I mean, it gets a lot of headlines, and we all see it when we go to the restaurants and we see how they're suffering. But it's actually relatively small compared to housing-related activity, related to technology-related activity. What we've seen is that a lot of us have risen to the occasion and done the best we can to restructure our businesses. And I think a lot of these people that have been hardest hit have done an amazing job of trying to stay in business. Whether they can do it, if they're locked down for another 2, 3, 4 months, that could be a real problem for a lot of them. But the reality is there's so much liquidity in the system that people are still going to spend money, and if you can't spend it at a local store, you're still going to spend it online or do curbside delivery. So everything is radically changing to accommodate us to that kind of world. And net, it's added up to a V-shaped recovery so far, and I think the economy is resilient enough to carry us through this. And there's plenty of liquidity still left over from the first CARES Act, and the Fed keeps pumping liquidity. And there's, as you know, there's $400 billion that Mnuchin got back from the Fed that Congress just has to give to people who need the support for a few months. So it's not as though we actually have to come up with new monies. There's other monies in the CARES Act that hasn't even been spent.
So there's money out that hasn't been allocated yet.
Yes.
So one of the persons asked, he said that there's the BIS said that we are entering the solvency phase of the crisis from the liquidity phase. What are the implications of that, or do you agree with it?
Well, you know, uh, about a year ago, before this all happened, both the Fed and the IMF put out their financial stability reports, and they were pretty scary. They said that if we have a recession or an event like the Great Financial Crisis, there'd be a tremendous amount of debt, corporate debt particularly, that would just default. And I forget what the title of the reports were, but I suggested both of them should have been called the zombie apocalypse. Both the Fed and the IMF anticipated that if we got into trouble again for one reason or another, it could be horrible. And the credit implications would be disastrous. And so I read it to us as so what are you going to do about it? In anticipation of it, are you working with corporations to try to deal with the zombie problem? Well, the way they dealt with the zombie problem is to lower interest rates to zero and to provide a tremendous amount of liquidity. So the zombies are still the walking dead. They're going to live to die another day, as the James Bond song goes. And all this excess capacity is fundamentally deflationary, keeping inflation down, creating problems maybe for the zombies themselves and creating more zombies. But there's nothing like near zero or record low interest rates to keep the zombies alive and to avoid the credit problems. And as I showed you in that chart, non-financial corporate borrowing, all-time record high of almost $1.5 trillion just in the past 12 months, which included a pandemic and a lockdown recession. So the central banks have provided liquidity to avoid the solvency problem. I mean, I think that it would be healthy to have the zombies buried, because then you wouldn't have the excess capacity, and you'd have inflation coming back to something more normal and healthier than constantly fighting deflation. But as I said, I'm not a preacher. I'm not a policymaker. I'm an investment strategist. I do bullish or bearish. I interpret what is being done and what is likely to be done, and what that should mean for financial markets. And right now, it's bullish until it isn't.
Got you. Well, fantastic, Ed. I wanted to thank you so much. I'm actually going to clap for you, and I hope that people at home are clapping for you. And great job.
Don't clap. Just sign up for the trial, and then if you like the trial, sign up for the service. So go to Yardeni.com, have a look at that, and see if you like the service. If you like my presentation here, I think you'll enjoy the daily that we come up with. Marty, thanks for the opportunity.
Hey, Ed, real quick, if you have a link to that, you can put it on the chat session here, the link to the trial.
I will.
And also, if you can email it to me, I'll blast it out to the 400 people that registered for this event.
Okay, that's fine. And I'll also send you the Zoom charts in case anybody wants them.
Fantastic, that works. And we'll have a cut of this presentation within 7 to 10 days. It'll be out on our video library. So thanks so much.
Thanks, Marty. Thanks, everybody.
Okay,
Stay safe, healthy, everybody.